I'd like to welcome Mr. David Blood to the stage, who is the founder of Generation.
You're going to stand behind me, are you? I see. As Colin mentioned, I'm a former investment banker. I bet you can't tell that. I saw John just a few minutes ago, and he said you didn't get the memo about business casual. And I confess I'm just not very good at business casual. I can't really, first of all, matching ties, and it's just not very good. It's a pleasure to be here, and it's a pleasure actually to be here working and supporting John and the team at Volans. And I want to tell you a little bit of a story an experience that John and I had just a few months ago, actually. We were together speaking at St. Paul's. This would have been in October. And it was just sort of right after Occupy Wall Street, Occupy London was taking hold and getting a lot of traction. And I gave a talk very similar to the one I'm going to give now. Hopefully it will be a little bit better, but you never know about these things. And one person in the audience had sort of called out to John and to myself to say, you know, you guys really should go and engage with the folks at St. Paul's. And I thought that was a good idea, and so the conversation came and went, and the speech came and went, and we're all sort of leaving St. Paul's because the speech itself was in the crypt. And John and I were walking out together, and John, by the way, was dressed very much as he is today, professorial and just wise and approachable and just an all-around good guy, and I was dressed like an investment banker. So we start going down the stairs, and I say, John, I think we're ready to go engage with this group and see what we can learn. And he looked at me and he said, I don't think so. Maybe you ought to just go back to the office, and I'll let you know what I find out. So anyway, those things happen. Colin is one of the founding partners of Generation, and I have to tell you that Colin, for a long while, was on my bad list because he suggested we name the firm Generation. And obviously, he won. But Al and I really wanted the firm to be called Blood and Gore, and to this day, it bothers me. And I just want you to know that, and all right, I'll see if I can work through it. We founded Generation almost 9 years ago, and we founded it because at the time, and still today, sadly, we felt that the markets are very short-term oriented. The global capital markets seem to focus on, and companies seem to focus on next quarter's earnings or even a shorter time frame than that. We think that that is terrible business. We think that's terrible investing. We think that's terrible for long-term economics. We also observed then, and certainly feel even more strongly today, that the context of business was changing. And indeed, environmental and social and governance issues were relevant to business always, but increasingly relevant to business. And therefore, an investment process, the capital markets, businesses ought to be incorporating sustainability into how they're running their businesses, and by extension, how we should be analyzing businesses and investing in businesses. And moreover, we observed that the sustainability challenges that the world faces, whether it be climate change, whether it be poverty, whether it be health, water, demographics, the list is long. We observed that these challenges were huge. They're interlinked and they're huge. And that in fact, civil society and government, while will be crucial to those conversations about making change and driving change, they didn't have enough capital actually to drive the change that we need. And therefore, business and by extension capital markets needed to be part of the solution. So we set about building an investment business that had two objectives. The first was to invest well for our clients, which are typically pension funds and other sources of wealth, family offices, foundations, and endowments, and we certainly aim to do a terrific job for our clients. But similarly, we made a commitment that we would be advocates around sustainability and around sustainable capitalism, with a hope that maybe our voice and some of our actions around investing in capital markets might help move the needle to help capital markets and business be more sustainable. And when we think about sustainability, or sustainable capitalism is the term we use, others, Michael Porter calls it shared value, Dominic Barton from McKinsey will call it long-term capitalism. There's lots of different terms today around the broad notion, but it really is about the long term. It's about pricing externalities. It's about being holistic in how you think about your operations, which means that you need to consider the environment. You need to consider your communities. You need to consider the folks who are working with you. You need to consider ethics. You need to consider governance. The broader challenges around ESG must permeate and drive the operation of this economic system. And it touches, in fact, all aspects of society and business and capital markets. It's not just public markets, it's private markets. It's not just developed companies, it's actually emerging growth companies, it's entrepreneurs. It's the most senior folks, it's the most junior folks, it's the NGO community, civil society, it's government for sure, and of course, it's business itself. And our view is that if we can convince the broader marketplace, and if we can focus on driving the broad understanding of being long-term and more holistic in how we operate our businesses and our capital markets, indeed we can therefore begin to address the challenges of sustainability. Again, climate change, water, the list sadly is long and is getting more acute. So, 9 years on, or actually, I'll tell a story of sort of 8 years, 7.5 years ago, we came to a recognition that our advocacy work had not really been very successful. And let me take you back to when we founded Generation in 2003. That was just at the beginning of sort of the broader conversation around sustainability. There were long-standing important voices, John being one, Oliver from Sustainable Asset Management being another. Many people in this room, frankly, know a lot more about sustainability than I do, and had taken a long time and with great effort to bring us to a point where a firm like Generation could begin to be part of that conversation. And indeed, as we started that journey in 2003 and we moved into 2007, we felt that the conversation around sustainability really was getting traction, that we were getting closer and closer to mainstreaming sustainable capitalism, and I'm not sure I like the word mainstream, but making it much more front and center of how we ought to do business. And then the global financial crisis occurred, 2008, 2009, and I remember Al and I wrote 3 or 4 pieces in the Financial Times and the Wall Street Journal around that time saying that in fact this was an inflection point. That in fact this would be the point where we would see an acceleration to sustainability, an acceleration to sustainable capitalism, because indeed many of the failures of capital markets and economies in 2008, actually 2007, 2008, 2009, were failures of sustainability. Whether that be leadership, whether that be governance, whether that be ethics, whether that be incentive structures, et cetera. They were failures of sustainability. And we thought that, my goodness, this is a time for us to seize the challenge and actually drive an acceleration to sustainable capitalism. And then, as I said, about 1.5 years ago, we looked around and realized we were wrong. That in fact, we hadn't seen an acceleration of sustainability. We saw, in fact, things going backwards or at best plateauing. And we stood back and said, well, why is that? What's happened that has caused the slowdown in momentum? And one very important fact jumped out at us, which is every time we started to talk about sustainability to businesses and sometimes to government, we would hear, no, 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 we have a crisis. We need to find ways to stimulate the economy. We need to find ways to create jobs. The sustainability stuff, this is nice to have. This is for better times. And what we realized then and there is that people didn't recognize that sustainability, sustainable capitalism, is integral to the success of economies over the long term. And what we realized further is that we had not made the business case to the broader marketplace and to the companies and businesses and investors that this was, in fact, about driving long-term economic growth. We also recognize that all of us in this field, oftentimes, and this is why this conference is so wonderful, we've historically been good at convening and talking, but a little bit less good about acting and encouraging each other to act. And so what we wanted to do off of that recognition is think about the actions that we could take as an organization to help drive change in the capital markets. And remember, we're ourselves focusing on typically public markets, although Colin and the team does focus on the private markets also. So we're in a slice of this broader capital markets, but we decided we would try to identify actions that we could take in conjunction with other players in the capital markets to try to drive change and to accelerate the transition to sustainability and sustainable capitalism. We say in our paper 2020, the truth is we have a view that it really needs to happen by 2015. Otherwise, we are increasingly in trouble. So there are 5 actions that we are espousing and are looking to partner with, and there's some in the audience who we are already partnering with. And let me just tell you what those 5 actions are as an invitation to get input and advice on how we might deal with them. The first is around integrated reporting. Today in the capital markets, you tend to have your financial statements and you tend to have your sustainability reports, or maybe you don't have sustainability reports. Our view is that sustainability is obviously integral to the success of business and therefore ought to be integrated into financial reporting. Bless you. So we would like to see the one report as opposed to a series of reports. So integrate sustainability into the financial statements is one objective. And there are thankfully a number of initiatives both globally as well as in Europe and the United States that are focused on trying to take those steps. And I think actually in this particular case, while in many cases we're not talking about legislation or mandate, in this case we actually do advocate that we mandate integrated reporting. A second issue for us is this notion around quarterly guidance, where, first of all, quarterly reporting isn't our favorite idea either, but what we really dislike is the notion that a company will say, I think over the next quarter, or we think over the next quarter, we're going to earn 35 cents a share. We think that that is terrible. We think what's happened is the market has become so fixated on whether a company hits those earnings targets or not, and in fact, that's causing companies to make terrible long-term investment decisions. And it's also skewing the markets and encouraging it to be more short-term than it ought to be. So we'd like to absolutely discontinue guidance for sure, and certainly the default practice of guidance where companies just sort of default to it. And we would certainly be willing and able to have a conversation around guidance generally. Actually, we like long-term guidance. We like guidance that talks about what is the company trying to do over the long term? What are the key matrices that they're trying to be evaluated with, which includes sustainability as an aside. That we like, but the notion of whether you make 10 cents or not next quarter is completely irrelevant to the long-term capital formation and long-term value creation. A third issue for us is incentive structures. Whether that be investment bankers, investment managers, or CEOs or business professionals within those companies, we think that the incentives need to be driven to the long term, and they need to be holistic. They need to embrace the values of sustainability that we espouse. And when you're evaluating a business or a CEO, it shouldn't just be on earnings per share. It should be how well have they built their communities, how well have they developed their teams, their staffs, what is their carbon footprint. These broader issues that are relevant to the long-term success of businesses ought to be included in incentive structures and compensation structures. And in the fund management industry, the notion that we're compensating fund managers on a quarterly basis or an annual basis is a flaw. It's a fundamental flaw to the investment processes, and it's causing actually the fund management industry and asset owners to perpetuate a terrible situation. A fourth issue for us is we would like to find ways to make investors be more long-term. And one way to do that is to create a different share class that might encourage long-term investing. Loyalty shares is one term. There are a small number of companies that have considered this. We would like to find other companies who are willing to engage and consider it as a way to promote and encourage long-term holding of businesses and ownership of businesses. You'll see a lot of research around the difference between a private company and a public company, and what you'll see when you look at that data is that private companies tend to manage themselves more from a long-term perspective. Public companies tend to actually make decisions, as I was alluding to earlier, much more quickly and much more in the short term. If we can convince the public shareholders or the public CEOs that their shareholder base is indeed long-term, if we can provide them capital that is still accountable, but long-term, then we think that we can begin to shift the direction of how businesses think and operate. And lastly, an issue that there's people in this audience who I know know more about this than we do, but we hope that we can add our voice to it, is the conversation around stranded assets. And this is a fiduciary responsibility for investors. To be clear, this is not a political issue. This is a core fundamental public policy and fiduciary issue. And it goes along the lines of this. If you're investing in energy businesses that assumes that there will not be a price on carbon, and you're making those long-term investment decisions based on that assumption, you are running a terrible risk for your pensioners or your obligations. And we're not going to debate the question around the science, although we think we could debate it all day long. We're simply going to say your job as investors is to manage risk. If you think that there's a 5% chance or a 50% chance or an 80% chance that there's going to be a price on carbon, you ought to factor that into how you're pricing assets. And it's not just carbon assets, it's water assets. There's a lot of natural infrastructure that we need to holistically consider when we're running our businesses. But I seem to make everybody sneeze. It's just terrible. Allergic reaction to me. John, what is this? In any event, we would like to work with the asset owners to raise this as a fiduciary obligation and responsibility, and then carry that on into conversations with public companies over the course of the first half of next year during earnings season. And we're hoping that as we make that issue, and along with Carbon Tracker and others who have really done a lot of work on this, we're hoping that we can make it, it's not a political issue, this is a core investment issue, it's a core fundamental question of the long-term health of economies and pensions and businesses. And so that is an area that we want to focus on. There are 5 other areas that we have identified in this paper, and if you don't have a copy, we're certainly happy to send it. There's lots of great folks who are doing as good a work, if not better work, than us on these subjects as well as others, and our goal is to sort of throw that out there and say these things we think can make a difference without imposing regulation necessarily, or without imposing other sorts of requirements that we as investors ought to take. Now, let me just close by reading a quote from Bob Shiller, who's a Yale economist, and he wrote a book called Finance and the Good Society. And I guess the way I want to conclude is this. Our partner, Al Gore, oftentimes talks when he introduces himself, and he says to the audience in the world that he's a recovering politician on around stage 9. And he means it, actually. He's pretty much out of politics. But I've never introduced myself as a recovering investment banker, because I actually think that finance can do the right thing. It can be an instrument of change. It can be a positive instrument of change. And what Bob Shiller says is this: finance remains an essential social institution, necessary for managing the risks that enable society to transform creative impulses into vital products and services. The connections between financial institutions and individual people are fundamental for society. Finance truly has the potential to offer hope for a more fair and just world. If you look at what finance has done over the last 5 years, or indeed over the last 25 years that I've been in finance, you might think that these words are not true. I think it can be true, and it has to be true given the challenges that we face. Thank you very much.